Hello and welcome. There are stocks that have come to the fore over the last couple of days, which we generally don't talk about. And one of those stocks or set of stocks are the textile stocks in India. They were in deep amounts of pain. In fact, over the last 6 months, this particular counter is up 35%. In fact, if I'm looking at the stock chart from May of 2025, when the pain was the most pronounced, the stock has doubled in terms of value. From 950 odd rupees, it's currently sitting at 1900 rupees, a 25% gain over the last 5 trading sessions on a Pearl Global, excluding Sunday. So we've seen very strong moves with regard to some of these counters. We'll try to understand structurally what has changed, fundamentally whether there are any risks, and whether going forward, does the runway look long, and does the situation look more of blue sky or not? So the first piece that I want to know is, and why Pearl Global? 75% of its revenue comes from US, UK and the EU, and they have spoken about doubling down on opportunities like Spain as a market. Now this could be large because what you know is, we know that Spain is a huge garment consumer in terms of brands, and therefore with the India-US ties done, with the India-EU ties done, and UK as a potential opportunity already available, you could well see a large growth opportunity in all those 3 key markets, and 75% of the top line comes from there already. That's really the first piece that I want to know, as to, does it substantially increase or enhance the kind of glide path or guidance that they are working with in terms of top line? Second, does the FTA change the strategy of a diversified supply chain? Now they've got a very well diversified manufacturing base across multiple countries. What we'll try to understand is whether that changes, whether now India becomes more lucrative versus, say, a Bangladesh, a Vietnam and the like, simply from a perspective that you have an India-EU FTA in place now with 0 tariffs versus a Bangladesh. You have an India-US treaty which is more favorable now to India than what a Bangladesh gets in terms of tariffs. The third piece is with regard to capacity utilization ramp up in Vietnam, Indonesia and Guatemala. Now, these 3 countries, smaller in comparison to the larger base that Bangladesh and India have, and I'll speak a little bit about the production base, of course, but these 3 countries have the scope to ramp up in terms of capacity. They're sub 50% and therefore presents an opportunity. The fourth one is the 10% capacity expansion that they are planning, and 250 crore capex timelines. And what next in terms of expansion? We'll try and understand that. Diversification of client base. The top 5 clients contribute 60% of top line, top 10 78%. Whether now with the FTAs coming in and with India-US also coming through, does this give them the runway to shift focus from their top 5 to 10 clients? Hedging risks, especially for cotton price volatility. Right now, they have that favorable tailwind coming their way. But whether that changes going forward, how are they hedging risks, if at all that were to change? Possibility of scaling margins to 12%. They're currently sub 10. What does this do? What does the India-US FTA do for them? What does the India-US trade deal do for them? And therefore, what does it do for their margins? We'll try and understand all of that. First, let me start off with quickly taking you through what the company does. It's a global export-focused manufacturer of ready-made garments, manufactures knits, wovens, denim, outwear, children wear. It is multi-country in terms of production. All of the countries will come up on your screen in just a minute. It supplies to leading global retailers. I'll give you names of those retailers as well. It focuses on an asset-light strategy. Some of it is asset-light with a mix of its own plus partner facilities that they currently have. Now, in terms of product list, let me quickly take you through those products. Children wear, sleepwear, they're across the board, and some of those products will come up on your screen. They also do sourcing services, integrated manufacturing services. They also do knitted garments, woven garments, denims, outwear. So they are there across the value chain. In fact, in terms of geography of sales, 46% of their sales currently comes from the US. EU contributes around 17%. Japan, Australia, UK, Canada, and others are also part of the mix. You'll see that. But predominantly US and EU, which is roughly 63 to 65% of their top line. If I throw in a UK, it comes to around 70% of top line. So that's broadly the kind of split that's there. Let's talk about the manufacturing. And within the manufacturing setup, 27% is India, 73% is the rest of the world. And let's also take a glance at how the rest of the world pans out in terms of manufacturing. They manufacture in their own facilities, plus they have partner facilities. India is 8 in-house facilities that they have, where they manufacture approximately 25 million or 2.5 crore pieces, which is around 24 to 25% of their total product, or maybe 26, 27% of their total product. I spoke about that. Bangladesh, though, 5.5 crore pieces is what comes out of Bangladesh. So India plus Bangladesh combined is around 8 crore pieces currently. Now, this is out of the 9 crore potential that they currently have in terms of the pieces that they sell. And in terms of capacity as well, Bangladesh is 85% plus. And therefore, there is a requirement to either shift back towards India a little bit or optimize their facilities, which is exactly what they're doing. They're doing capex on the back of that. So they manufacture in all of these places. This is how the manufacturing setup currently looks like. And you can see the partner facilities as well. Indonesia, Guatemala, Vietnam are places where there can be optimization, which could play out. India, Bangladesh is heavy in terms of capacity utilization already. But what is important to understand is where also do they sell to and their customers. And let's quickly look at their customer list as well. Marks and Spencer, Levi's, Ralph Lauren, American Eagle, Walmart, Kohl's, PVH, Gap, they're across the board in terms of their customers. But concentration in terms of customers is where the possible risk lies. So again, something to take care of. Now let's look at the metrics that we always track. The P&L account, you've seen revenue growth of around 18% last 3 years up to FY25. EBITDA growth of 38%, very, very impressive. As they're scaling up, they're enjoying operating efficiency play out, and profitability has therefore grown at 49%. Debt has come down, interest costs have come down, and therefore you're seeing a bump up with regard to profitability. So very impressive kind of numbers, a clear thumbs up. You look at the 6-month period, that's not the 9-month period, that's the 6-month period from FY25 versus FY26, and you'll see a 26% revenue growth. You will see, you will also see a 33% EBITDA growth and a 17% PAT growth. So very healthy. Again, margins have inched upwards. When you're looking at the margin trajectory as well, let's pull that one out, and you'll see that the margin trajectory has gone up. We've come off a little bit because of certain tariff issues, but the 6-month margins continue to be above the 9% mark. The Q3 numbers are still awaited, so that's something to kind of consider. Let's look at the cash flow now, or the balance sheet now, first off. With regard to the book value, it lies at around 1,200 odd crore, 1,290 crore at the end of first half FY26. And you have a borrowing number of around 500 crore on the balance sheet. At the end of H1 FY26, it's come off a little bit from that FY25 number. And it also has a cash bank balance of around 490 crore at the end of FY26. So a borrowing number largely offsets the kind of cash back balance it has. It's in fact very, very low net debt currently, which is again a positive. No concern on the balance sheet front either. You look at the cash flow also looks healthy. FY25 was a tough year where cash flow is concerned. That's because of inventory buildup that has happened here in this year. But outside of that, you look at the cash flow, EBITDA to cash flow conversion, it's fairly healthy. And therefore, while we're neutral, because of the inventory buildup, nonetheless, it's overall looking decent. When you're looking at the return ratios, you're seeing a sharp jump in the return ratios, as is the case with the profitability. And you'll see how the return ratios are now sustaining at 19 to 22% in terms of the return ratio as well, in terms of the investments they are making. That's the ROC number, mind you, viewers. Now let's look at shareholding. 60% odd held by promoters. Again, very comfortable promoter ownership. You've got FIIs, DIs also participating significantly. You look at the DI interest that's gone up over the last year and a half. You've seen sharp increase in DI interest. Public, therefore, has come off as a result. Let's look at the analyst coverage. Again, very few analysts cover this one. So we're a bit cautious with regard to this. 4 buy calls, no holds, no sells, 15% upside. We've given it a thumbs up, but mind you, viewers, caveat there are very, very few analysts that cover this one. When you're looking at valuations, currently trades at around 34 times, FY26 numbers, FY27. If you look at the 1 year forward, it trades at around 24 times, and FY28 is at 17 times, mind you. And the average, the 2 year average is around 21 times. That is given there, the 2 year average price to earnings ratio. Now, let's go across. That is obviously a snapshot of everything we've discussed. I believe that is the snapshot, correct? So you have all of that wrapped together in terms of our analysis. What we'll do is slip into a very short break. On the other side, we'll speak with Pallabh Banerjee, the Managing Director of Pearl Global, to get us a sense as to what lies ahead. Stay with us. Welcome back, and we're in conversation with a very interesting management of Pearl Global. 75% of top line coming from US, EU, and the UK. So that's big. Now, Pallabh, what does this do? Give us the view with regard to whether the top line guidance of yours of 12 to 14% changes dramatically, because you've got now India, US in place. You already had India, UK. And now you have India, EU as well in place. That opens a large opportunity for you as an Indian company.
Thank you, Harsh, first of all, for having me in the show. Although we're in a silent phase, so not too much of numbers, but
sure.
in terms of vision, if you look at it, the markets, which are sizable markets, are like the EU, the US, then followed by Japan, UK, Australia. So these are the 5 big markets, which are very matured and a developed market, which we are catering to. And so that if you see the size of this market in terms of apparel, that's almost about $260 billion plus of imports that these countries do from the rest of the world. If you look at Pearl Global, we are also globally manufacturing and supplying to these markets. Yes, historically, we have been very heavy in US market. If you go back 4 years back, almost 85% of our sales was coming from US. So as we continue to diversify that, you will see that the other markets are growing much faster. In the same period of this last 4 years, maybe we have grown 2.5 times or even more. But then the rate of growth that has happened from the rest of the markets has been much more than the US. That's why this balancing is happening. So yes, we have been planned and projected to grow at the rate of what we have been always saying, that anywhere between 12 to 15%. We will continue to do that. There are always some opportunities that comes through, because the whole globe is quite volatile in terms of business now. There are a lot of from the WTO kind of structure that we were in, is a lot of bilateral trade agreement, free trade agreements. All this movement is happening, so it will throw us more opportunities. Mind you, we are not talking of only India. As a company, we are manufacturing from these 5 locations: India, Bangladesh, Vietnam, Indonesia, and Guatemala. So most of these countries are also doing these trade agreements. So the order in terms of what it was used to be in terms of trade agreements is moving to a new thing. So we have to continuously update ourselves. And of course, it gives us those opportunities and sometimes the risks. So how do you mitigate those risks and take benefit of opportunities?
Point taken. Pallabh, are you in conversation with companies sitting in Europe, companies sitting in the US? Given that these trade agreements have come through, have companies reached out to you saying, okay, this is a great time for us to tie up because we want to take advantage of these FTAs or of this FTA in particular and of the India-US deal? Are you in conversation with potentially new clients?
Absolutely. So we are always seeking out the best of the companies. If you see today, our customer profile is almost about 30 odd customers, and the always the intention is to focus and grow those best ones who are financially very sound, getting more and more what do you call market segment that they are capturing. And if we see that these companies are growing, and if you grow with them, that's always healthy. Uh, and yes, you have to always mitigate the risk. We cannot work with those kind of retailers who are financially not sound or are going into some kind of risk category. So that's a very important part of the business when you are selecting a customer. With this FTAs that has happened in European Union and UK, there are customers who are in conversation with us. Some of them are already our customers in the other regions, like Bangladesh had duty-free advantage, and Vietnam also entered into a comprehensive treaty with these countries, and they were getting these advantages. So these retailers were already talking. India, of course, is loved by everyone. This particular day, like day before night, if I speak about, as these announcements were coming, so everybody was calling at that point of time. So it was not a peaceful night. It was definitely a lot of calls, a lot of sleep was going on. So this something is the nature of our trade. So yes, we are in conversation. There are opportunities. We will be looking forward to make best of those opportunities.
Pallab. Okay, talk to us about two things. One, what does this trade agreement with the US change in terms of your supply chain? You have, my guess is you would have used your diversified supply base to try and counterbalance on the India tariff that was getting levied from India. So sourcing would have been diversified. Now, does it come back to India is what I'm trying to understand. And second, what does it do to your margins, Pallab? Because you must be taking some bit of a knock on your margins because of the India US tariff of 50%. Now with 18%, does your margin profile improve even a tad bit, maybe on a very small revenue base, which was getting supplied from India to the US?
So you see, what was happening is that since last August, when U.S. Trump administration imposed this high tariff on India, so there are two things that happened. One, definitely, the retailers who were working in India, not only with Pearl but with any other suppliers from India, so they were under pressure because they cannot pay that another additional 50% of tariff. And mind you, like all other countries where they're importing from, were also undergoing this tariff. The rest of the countries, if I talk about the garment suppliers, supplying countries, wherein the additional tariff they got is around 20%. So again, like if I take a step back, under WTO there was a MFN tariff, so which was for a cotton product anywhere between average around 15%, 12 to 18% is the range that different apparels were getting that kind of duty structure. And if you talk of synthetics and all, it was a little higher in the range of 20 to 26%. So when Trump administration added a layer on top of that, so on top of what was the existing tariff, he added 20% for most of these garment supplying countries, and for India it became 50%, 25 of reciprocal tariff and 25% of this penalty. So that got India into a 30% disadvantage. So anyway, all these retailers and brands who are importing goods from all over the globe into US, suddenly they had to pay this extra tariff as the goods were coming into USA. So that's the kind of pressure they were in, and they were asking all over the vendors to support that. But then
Right.
after this differentiation came in, like India became 50 and everybody else was at 20. So then definitely they had the choice. Either they move out the business, or if somebody is supplying from India, then they would pressurize those suppliers to to absorb that 30% difference, which was coming
Right.
out to be almost about 15% or 17% kind of discount that we had to give to have that business in India. For Pearl, they were putting two kind of pressures: either you do it in India, share this burden, or you shift it to other countries and you don't have to share that burden. So that's what was going through. As this thing is getting reversed, So naturally, the whatever goods that we are shipping from India, we don't have to pay this discount now anymore.
Correct. Correct.
So that's up to the bottom line, naturally.
So, okay. Yeah, I get your point. So 12% margin, that's the aspiration. How quickly do you get there? Because now there's certainty.
So that's a journey that we are in. As you see, like any company, it's sometimes you do cart before the horse or horse before the cart. So naturally, we have built up a good infrastructure across so many countries of manufacturing, as well as our design and sales office and marketing offices also are there now in US, in Spain, in London, in Hong Kong. So all these places. So we have spent that money. As this volume continues to grow, we get a leverage. Definitely, if India bottom line gets better, we get that leverage. We had opened up a new venture in Guatemala a couple of years back. So that's still yet to break even. As that breaks even, we get again more leverage. So there are, these 5 or 6 levers are always playing. In Indonesia, we had to shift one of the factories which were near the waterfront. And because of the global warming, the water was coming inside the factory. So with 3 years back, we had to shift that factory to other place. Now that ramp up is happening. So these levers continue to play in, our bottom line will continue to improve. You'll see that.
Understood. Pallabh, unfortunately, that's all the time I have on this edition of the show. I would have loved to chat more. But thank you so much for coming in and giving us that perspective. Viewers, on a 13% growth, if that were to happen over the next couple of years till FY28, the top line will go from 5,000 crore FY26 expected to around 6,500 crore FY28. If margins were to go up from 9 to 10 to 11, that will likely mean a profit after tax of approximately 500 crore. This one's trading at 8,700 crore in terms of the market capitalization, which gives this a valuation of around 17 times 2 years forward. If you're playing the India-US and maybe the India-UK theme, this could well be one of the stocks which should be on that list. So anyway, that's all the time we have. Thank you so much for watching AAYC.